Let's talk about how to analyze multifamily. I want to go over some key concepts and metrics to look at when analyzing multifamily. So pay attention to this course specifically. You may need to watch it 3 to 4 times to really master it, but the key is to practice and constantly analyze deals. The more deals you analyze, the better you will get. Let's talk about the most important question when analyzing multifamily. Does the property make me money every month? Once again, does the property make me money every month? The answer should always be yes. Yes, yes, and yes. If there's no cash flow, say no. That's my saying. What type of apartment complex will not make me money every month? These are the deals that beginners must stay away from. Apartments that need full gut rehabs. This means that the apartment complex is 100% vacant. There's only stud and wood. There's no drywall, there's no flooring, there's nothing. It's a full gut rehab. High vacancy properties, that's greater than 50% vacancy. I can guarantee you, if you get a high vacancy apartment complex, no traditional lender will touch it. You'll most likely have to get a hard money lender, which charges 10 to 14% interest, 3 points up front. For the apartment that needs a full rehab, same thing. You need a hard money lender, and you'll be negative in terms of cash flow until you're done and it's rented out. Also, ground up development for apartments. Ground up development takes a long time. If stabilizing an apartment complex takes 2 or 3 years, ground up development takes 5 to 10 years. And in that 5 to 10 years, there's so many factors out of your control. They can have code standard upgrades. There can be laws that pass that make it more difficult. There could be a labor shortage. There could be a supply shortage, like during COVID. There's so many factors out of your control. So these types of deals are for more advanced investors. So beginners, stay away. Even me, when I'm more advanced, I don't want to deal with these deals. I'll be honest. It's way too much work, way too much headache. It's not for me. It might be for you, but please wait until you're more advanced. Well, let's talk. What do you need to analyze multifamily? You must get the income per year, get the expense per year. Once you have the income and once you have the expense, you can calculate the net operating income. From there, you can calculate the debt service per year. And from there, your cash flow equals the income minus the expense minus the debt service. Remember, the NOI equals income minus expense. The NOI does not include the debt service. All this information is found on the T12 or the trailing 12 document. That's a fancy way of saying a profit and loss statement for the last 12 months. If you're given all three of these numbers on a monthly basis, all you do is multiply it by 12 to get it per year. And from there, you can analyze your multifamily property. Pretty simple. What do you need to analyze multifamily? So when I approach an owner, approach a broker, I always ask for the most recent rent roll. For example, it is August 19, 2022. I want a August or July 2022 rent roll. From there, I can add up the monthly rents on the recent rent roll and multiply it by 12 to figure out the annual income. What you want to do is you want to compare this to the annual income on the T12 provided, and this should be within 5% of each other. If it's not within 5%, do a deeper dive as to why. Were a lot of tenants evicted and new tenants are being brought in? Were a lot of units being renovated and higher rents being obtained? Was it completely vacant apartment complex and units are finally being leased up? So if you see a 5% variance, just dive deeper as to why. And once you have the monthly rent roll and you times it by 12 months, you get your monthly rent roll, times it by 12 months, you divide it by your annual income on your T12. That's how you calculate your variance. So let me go over a couple rules that I emphasize when analyzing multifamily. And the first rule, which is the most important, is positive cash flow. If the cash don't flow, say no. All multifamily deals must have positive cash flow. Commercial lenders want to see a debt service coverage ratio, or DSCR, greater than 1.25. What is a DSCR? It's the net operating income divided by the annual debt service. If your DSCR is greater than 1.25, then there's a good chance that you have positive cash flow. So if the lender wants positive cash flow, you should want positive cash flow. And if you have positive cash flow, that means that there's a higher value of the apartment complex. So rule number one, you must have positive cash flow. Rule number two, cash on cash return greater than 8%. What is the cash on cash return? It equals the cash flow divided by the down payment. I actually have a calculator that I will be going over that will help you calculate the cash on cash return. And why an 8% cash on cash return? Well, the S&P 500 averages 7% cash on cash return without the tax benefits. Banks like Chase, Wells Fargo give me 0.01% return on your savings. Inflation outpaces my bank, unfortunately. And CD investments give you 2% return on your savings. Once again, inflation outpaces CDs in 2022. So that's why I aim for 8% cash on cash return. That's just me. Some people are okay with a 4 to 5% cash on cash return. It just depends on your situation. If you have multiple streams of income coming in through a business, through your W-2 job, maybe you can take a lower cash on cash return. For me, I want at least an 8% cash on cash return day one. And what you want is, with a cash on cash return, it increase the velocity of your money. How long does it take for you to get back your down payment based on the cash flow? So if your cash on cash return is 10%, it's going to take you 10 years to get back your initial down payment. So the higher the cash on cash return, the higher the velocity of your money is. For my rule number 3, my last rule, the cap rate must be greater than 6%. Remember, cap rate equals NOI divided by the sales price. Start in markets with at least 6% cap as a beginner to get more cash flow. Remember, if your goal is to leave your W-2 job, you need cash flow to retire early. That is my goal, ultimately. And to figure out the cap rate, just Google, what is the market cap rate for your city? What is the market cap rate for Oklahoma City? As a general rule of thumb, Southeast markets where I invest have a cap rate greater than 6%. This is my rule of thumb that I use. Like I said, depending on your specific situation, you can maybe work in a lower cap market. But for me, and for most beginners who want cash flow, start with at least 6%. So let me go over some rules of thumb for operating expenses. It's OPEX for short. Always assume the OPEX equals 50% of the gross income. This will make doing math, calculating your NOI, very simple. If your income is $100,000, assume your operating expense is 50%, so that's $50,000. So your NOI will be $50,000. Very simple, right? If the T12 has an operating expense less than 50%, then you must round it up to 50%. This is so common on off-market deals. All of the profit and loss statements that brokers give me, that owners give me, are always 30 to 45%. But based on my experience, it's always 50% or more. So do not fall for their numbers. They're just intentionally lowering the expense to increase the NOI to justify a higher sales price. If the T12 has an operating expense greater than 50%, let's just say it's 60%, then you assume the higher percentage of 60%. So if it's an all bills paid apartment complex, what is all bills paid? All bills paid is the landlord covers the water, the sewer, the trash. It's very common. But on top of that, the landlord will cover the electricity and the gas. So what a lot of tenants do is they have no skin in the game. They can blast the AC and open the window up and your electricity bill will go sky high and you will pay for it, which is why for all bills paid, assume it's 60% minimum. Operating expense is always underestimated and understated in the T12. Well, why is that the case? In all the apartments I bought, the owner always has cheap insurance, very cheap insurance. That's not good. In the module, I will discuss actual cost basis versus replacement cost basis. And you always want to focus on the replacement cost. And if you buy that policy, it's always more expensive versus the actual cost. So that's why the operating expense is always understated. Number two, the owners self-manage. So there's no property management fee. Property management averages 4 to 10% depending on how many units you have. If you have close to 100 units, it's probably closer to 4%. If you have around 20 units, it's maybe around 8%. The owner always has deferred maintenance. So a lot of these mom and pop owners are cheap. They don't fix things. So when you take over as a new owner, the tenants will put in all these requests to get everything fixed. And that will increase your operating expense. And lastly, the owner has lower property tax. They bought a property at the cheaper price, and based on a percentage, their property tax is less. If you're buying at a higher price, because for the owner to make money, then your property tax will be higher. And I have a module on how to figure out your property tax rate to estimate it. You just can Google it. Once again, what is the property tax rate in Oklahoma City? They'll tell you the percentage, and you do that based on the purchase price, and you will know exactly how much your property tax is. So this is why, general rule of thumb, operating expense is at least 50%. Keep it simple, 50% or more.